Hello, and welcome to this episode of Moments in Credit Union History, sponsored by CUNA Mutual Group. My name is Stephanie Smith, and I am the Executive Director of America's Credit Union Museum, located in Manchester, New Hampshire. Today, I am pleased to welcome to the show Chip Filson. In 1977, Chip's credit union journey started with the Illinois Department of Financial Institutions as a credit union supervisor. In 1981, he moved on to NCUA, where he was the president of the Central Liquidity Facility. And in 1985, he partnered with Ed Callahan and Bucky Sebastian to form Callahan and Associates. Today, Chip is with us to share a little bit of the key moments in credit union history that helped bring us to the period of deregulation. Welcome, Chip.
Thank you very much, Stephanie. Stephanie, before I jump into the three things I'd like to cover, I'd like to give our listeners a little bit of perspective so that these comments can be put in context. The first perspective shows the history of the credit union system from 1909 up through 2009 and 10, what was known as the financial crisis. And you'll see this history is divided into what I call 4 chapters, each of about 25 years. The first was proof of concept. The second, after the Federal Credit Union Act, was the national expansion. The third was this whole era of building out the system. And then the era of deregulation begins in 1984. So I think looking at that approximately 100-year history helps a reader see the part of and time where I'm talking about. The second diagram that I think is helpful is to see where cooperatives fit in this post-deregulation era between the two dominant forms of social leadership, social interaction. On one side, you have market capitalism with an ideology that best plays for people for a society to get solutions and to build on concepts of freedom is in the free market. The other side is government is very necessary to not only regulate the excesses of capitalism, but sometimes to even equal out some of the inequalities that come in. And as you'll see in this slide, cooperatives sit right in the center of those two poles. And I think there's always this tension that's pulling them one way or the other. It's been there from the very beginning.
Sure.
So putting those two things in context, I'd like to talk about the one era of deregulation and to spend most of the time, ironically, not about how it was implemented at NCUA, but what led up to deregulation. I think there's lots of confusion today and misuse of the term deregulation. Sometimes it's seen as pejorative. Oh, that's bad. You're going to let the people get away from something the government has backed off. Or other people feel it's a term that gets government off their backs and is what we should be striving for. And I think both of those interpretations are wrong. I think what I'd like to do is set up how Ed Callahan, Bucky Sebastian, and I, when we arrived at NCUA, felt and believed that deregulation was the solution to a very serious economic situation that existed in 1980-81. If you recall, there was double-digit unemployment, double-digit inflation. The misery index, adding those two numbers, was used in the political campaign that caused the change of administration to bring in President Reagan. But I'd like to go back and talk about what we found in Illinois, because Ed, Bucky, and I had 5 years to learn about the credit union movement in the context of a almost experimental case that made it a real learning experience for the three of us. When I got to Illinois, when I transferred to Illinois from a career in banking, the Illinois credit union system was just emerging into prominence. The numbers that were recorded at that period of time were significant. Illinois had the largest number of state chartered credit unions of any state in the country. It had passed its Illinois Credit Union Act in 1925 before the Federal Credit Union Act was passed in 1934. When I became credit union supervisor, there were approximately 1,100 state-chartered credit unions with total assets of about $1.2 billion. And if you do the math, that means the average credit union was about $1.1 million. They had experienced a 5-year compounded growth rate of over 14%. They had a loan-to-share ratio of about 85%. They had a net worth of about 9%. So the industry on the surface was prospering, albeit very, very small. When we arrived, the regulatory issues were multiple. The share draft, or remote withdrawal of shares, as it was called, or negotiated order withdrawals, was being challenged by banks. There were classes of shares that had constantly to be updated by regulation because the economy and interest rates were changing so fast. The fields of membership were limiting as businesses moved, closed plants, or failed. There was just multiple situations that the credit union system faced, even though on the surface it looked to be very successful. The institution, the Illinois credit unions, ranged quite dramatically in size. United Airlines Credit Union was about $250 million, in the top 10 nationally. Caterpillar was in the top 20 nationally at $150 million. Great Lakes and Military Credit Unions was about $50 million. And all of these were organized around what might be thought of as traditional fields of membership. And the forces of economic change and ultimately the crisis at the end of 1979-80 caused these fields of membership to be less and less viable as a static concept. When we arrived at DFI, Ed had a powerful reputation as an administrator. He had briefly been Deputy Secretary of State, which was the largest employer in the state of Illinois. But prior to that, he had worked as the superintendent, principal, coach in the parochial school system throughout the Midwest for over 20 years. And it was his reputation as an administrator that had brought him into state government. And the new governor in Illinois took him and asked him to clean up a Department of Financial Institutions whose prior two directors were under indictment for taking bribes. And so we had a dual challenge. We had to upgrade the entire department, get people that were experienced and knowledgeable and able to carry out the tasks that were there. And so if you look back, some of the people that we hired became very prominent in the credit union system after their time as regulator. Bob Force went to the State Farm employee system. Rex Johnson left, formed Baxter Credit Union, a leading credit union today, and then set up his own company. Ray Johnson became a credit union CEO, and several others that were brought in to become part of the regulatory part of that time, then left and became credit union leaders in their own right. Secondly, Ed was a strong believer in efficiency and wise use of funds, and this was the era where the computers were just being brought in. The agency automated the entire process of collecting call reports. We turned that around and gave that information back to the credit unions to help them analyze their performance versus peers. So people and efficiency and competence. I think the other thing that marked our approach was dialogue, constant dialogue with credit unions. There was a credit union advisory board. We spoke frequently at chapter meetings. We were invited to most of the league's annual meetings, governmental affairs conferences, and so on. And this mutuality resulted in passage of a recodified Credit Union Act in 1979 that reset the framework within which credit unions could then operate. So it mandated a choice of share insurance. It could be NCUA, it could be a private insurer. It gave credit unions complete choice about how they would structure their share accounts. It gave them opportunities in the field of membership to open up where they thought they could serve their members best. And the result was the credit union system just grew and grew and grew and expanded, and it was done mutually with the industry itself. There were leaders that we could reach out to for counsel. It wasn't just Dick Ensweiler at the League. People like Gene Artemenko, Stan Holland, who worked at Caterpillar and then left to become a private consultant before going out and working at Golden One in California. Many people like that were very influential in helping us to understand both what credit unions were and what they had hoped to be. One example of this was Dick's number two person was Chet Urban. And in Illinois, there was this consolidation occurring through both voluntary liquidations and mergers, and quite frequently we would run into problems, and it was very easy to pick up the phone, to call Chet Urban and say, hey, we think we've got a problem, we need help, and Chet would automatically get on the phone. He would listen to what the examiners thought the problem were, then send in field staff to help. And that mutuality was critical, I think, in the success that we had, not only in stepping back and working to revise the regulatory framework, but also in the outcome that credit unions had. So at the end of 1981, Ed Bucky and I went out to NCUA. Ed was selected as chairman of the NCUA. Bucky was the executive director and general counsel, wearing both hats at once. And as you indicated, I was president of CLF, but also had responsibility for managing the Share Insurance Fund and the examination and supervision program. And basically, the game plan we followed there was the same that we had learned in Illinois over 5 years. We had made mistakes, I had made mistakes, but we were on the ground constantly with credit unions, working with them and trying to do the best we could to help the industry succeed. And so the same pattern we followed. Bring in the best people you can, put the people out in the field where they could work with credit unions. There was a complete automation exercise undertaken. The agency had not even collected call reports from all federal credit unions. So one of the first fire drills that Ed did was to collect a call report from every federal credit union at December 1981. We went to an annual exam program. Credit unions had not been examined for several years, or the average exam time was several years. We mandated there should be an annual exam program, which is what we've done in Illinois. In Illinois, we had done it both with examiners, as well as the Illinois Act allowed us to accept CPA examinations as well. And so this began the process of deregulation. But to say that credit unions ask for deregulation would be a mistake, because, as I said earlier, it's often viewed as a pejorative term. I can remember we made one visit to a very large credit union in the DC area, and this was during the period of time in which Ed had said that deregulation would be a priority. And this credit union said, we're ready for it, we want it, but we don't think the small credit unions can handle it. And so the first thing that Ed undertook was a communication program explaining what deregulation had meant in practice. And the primary video that was put out, Deregulation, What It Means, was a product of the Illinois Credit Union League and featured a panel of 5 credit union people, including 3 credit union people that had lived through it, plus Jim Barr from CUNA. And so there was an effort here to explain what deregulation was about. And at the GAC conference in 1982, Ed's first time to speak to that conference, Jim Williams, who was president of CUNA, said, there's only one thing on credit unions' mind, it's survival. And Ed then took up the challenge and said, we're going to get through this together. The process is going to be deregulation. And all of the things that we had spent 5 years learning to do and the mistakes we had made, then we were able to implement very, very quickly at NCUA. The credit union system was completely share deregulated in one fell swoop in April of 1982. The banking industry and savings and loans were also deregulated, but they did not complete their phased deregulation until June of 1987. In other words, credit unions got a head start. And the numbers after that were terrific. There was double-digit share growth, double-digit loan growth, and the problems credit unions were facing from the economy were overcome by their new capacity to compete openly in the market. But there was a second side to deregulation. It just wasn't what credit unions did. It was the infrastructure at the agency, the infrastructure that interacted with credit unions. I've talked briefly about examination, computerization, call reports, but there were two other elements of the credit union system that needed upgrading in this new environment. The first was the CLF. The Central Liquidity Facility had been authorized in 1977 legislation. It didn't open until 1978, and it was serving only a very limited number of credit unions, about a half a dozen corporates and some direct members. And working with U.S. Central and the corporate network, we were able to fashion a structure that covered every credit union in the country, either through a corporate or through direct membership, so that the CLF was now available to every credit union. It became the cooperative liquidity safety net and really filled out the three-legged regulatory stool: supervision, chartering, examination, insurance, and liquidity. And at that time, credit unions were not eligible to become members of the Federal Home Loan Bank system. That was not done until 1987. They were not eligible to become members of the Fed. So having their own liquidity source was very, very critical, because until that time, they were dependent upon the banking industry, their competitors, if they needed backup lines. So that was completed in a very mutual way, where the industry helped fund its own liquidity net that was widely used. And I'll get to the first instance where it became very important. The second thing that was done in 1983 and 84, the NCUSIF insurance fund's equity level was hovering between 0.2 and 0.3%. The NCUS was not formed until 1971. It had used premiums to try to build up its capital base, but the combination of rapid growth in credit unions plus the occasional problems meant that they had not been able to get anywhere near the 1% equity base that had been mandated in the law. And in 82 and 83, we assessed double premiums, which of course credit unions did not like. It was an expense that they had to endure, and yet that showed that it wasn't working. So we did a very long study looking at the history of credit union insurance, why it was begun in 71, when it was begun, the pattern of over 20 state chartered cooperative insurance programs, what they had learned from their experience, and proposed a better way based on this analysis and the experience of credit unions and the cooperative model. And that better way became the 1% deposit that credit unions would keep funding as long as their shares went up. If they went down, then they could get a minor refund. And on top of that, there would be this 0.2 to 0.3 equity base to protect the 1% share should there be problems. The premiums were then restricted, so they could only be used if the fund fell below its 1.2% floor, and it could only be assessed once in a year. There could be no premium assessed if the fund was above its 1.3% legal cap. And if the fund did exceed that, it was mandated by law that that overage must be paid back to credit unions in a dividend. So now the financial structure was complete. The agency was doing annual exams. It was putting out, collecting timely call reports and putting that information back out. We were very active in communications with credit unions. Ed took the board on the road so that every one of the 6 regions would be able to see and attend a board meeting. The NCUA video network was expanded to include all the initiatives that were there. The first crisis that we ran into that wasn't part of the economy when we got there was the Penn Square bank failure in Oklahoma City in 1982. It happened over the 4th of July weekend, The occasion was we were having a external NCUA board meeting in conjunction with NAFCU's annual meeting in Chicago, Illinois. And Bucky had been called over the weekend by the FDIC saying that they were going to close the bank, and there were a number of credit unions in there that had deposits in excess of the $100,000 insured limit at that point. So he spent the weekend getting the numbers, and the first question that came up in the open press conference after the board meeting, Bucky, Ed, and I were sitting at the table, what's about Penn Square? And I'm not sure who asked the question. I've got this impression it was Larry Blanchard, but I'm not sure. And the question he asked was a direct query as to whether this meant that there needed to be a new regulation, whether this meant that now credit unions should be restricted in how much they could invest, even in an insured savings and loan, to the $100,000 limit. He directed the question at me because there was going to be some possible insured loss here, and I said instinctively no. That's not the way that you react to failures in the market with another regulation. Ed and Bucky picked up the response very quickly and showed that the entire resources, the liquidity resources, the NCUSIF, were now available to respond to this type of situation, because the insurance fund wasn't meant to be a liquidation fund when credit unions got into problems. It was first meant to be a stabilization fund. It was to help cooperatives that didn't have access to external capital to stabilize their operation, even with capital injections or with 208 guarantees, so that they could recover when times were overwhelming, sometimes not even due to their own circumstances. External events would close a plant, would cause some type of crisis that the credit union could not have anticipated and had no control over. So now all the resources of NCUA would be used, and the losses on Penn Square were de minimis. No credit union itself closed because they failed to get the receiver certificate. Some did merge afterwards, but not a credit union failed, and I think there were some 60 that were involved in the operation. So deregulation was a way that the industry and the regulator worked together mutually to not only create an environment that maximized the potential for cooperatives, which were now, as you remember from that chart, facing the open marketplace. Deregulation meant there was open market competition, no longer these safe charters where nobody could compete, and consumers had a choice. So now credit unions were on their own in the marketplace. So that's briefly the history of deregulation. It isn't an ideology. It's not an academic term. It was a lived experience that we tried to do because of what we had learned in Illinois at the same time when we got to NCUA.